every cycle leaves its own mark. It's a story of excess, correction, renewal. Yet this time feels a little bit different, right? Inflation fought back harder than expected. Policymakers blinked a little later than usual. And as if macro uncertainty wasn't enough, we had DeepSeek put the whole AI hype to test. And after all of that, markets still refuse to blink. So now we stand at very interesting crossroads where we are having growth without clarity, liquidity without comfort, and opportunity without consensus. And the question is not really where to invest now, but also what kind of an investor does this situation demand? And today our panel will delve right into that debate and that tension across equities that defy gravity, bonds that are just coming back to life, and private markets that are rewriting the rules of value creation. Please join me in welcoming Samantha, Scottie, and Alex. Thank you so much for joining us today. So we got a lot of questions from you all. And that's why we have all of them to answer those. Let's start with the audience question. Given the heightened uncertainty in 2025 with geopolitical unrest, political change, persistent inflation, how should investors think about positioning across asset classes? It's basically the holy grail. So Samantha, let's start with you. I mean, you look at across asset classes. How are you recommending positioning for investors now?
Cautiously. There's so many risks in the world right now that you just have to know exactly what's in your portfolio and why you own it, and if something goes wrong, what are you going to do with it? And that's for each and every asset that you own. It could be a bond, it could be a stock, it could be an index, it could be a private asset. You just have to know what you own. That's one of the biggest things, biggest things that you have to understand right now. I mean, as you said, equity markets have been defying, logic and going up and up and up. The bond market is, in a state of tension, I would say, and private assets are, mostly valued every quarter. So there's a lot of different things, levers to play with within your assets and within your portfolios.
Absolutely. So, Scottie, given persistent inflation, what business models and investments are you seeing which are promising a little bit more at maintaining real returns, like not just following the nominal growth? Like, do you have any ideas or themes that you're observing on your end?
Yeah, I wouldn't necessarily say a specific sector. I think it's really important to look at the specific business models of any company that you're looking at. So things like, is it a leader in their space? Do they have strong pricing power? Do they have contractual nature of their revenue that's got some built-in escalators? Things that are going to be asset light might be a little bit less sensitive to certain things. That being said, if their revenue is driven by things that might benefit from an inflation, perhaps there's a natural hedge that goes on there. So I think really digging into the fundamentals of the business model is more important, quite frankly. Certainly you can look at sectors from what's benefiting from secular trends, what should have more durability. That's going to be important in any cycle. I would just say the flip side of that, right now in an environment that's this dynamic, especially, smaller business that may not have as much vertical integration if they make a product, may not have as much control over their supply chains, that's probably going to be higher risk in an environment like this. So probably things erring to the benefit of the leaders of a given sector is probably going to be more true at this moment.
That makes sense. So basically going back to the drawing board, focus on fundamentals. Alex, Wealthfront's business is built around the concept of the passive investing concept, right? Can you share a little bit more about the key strategies that you're recommending your investors or customers?
Sure. Well, we're big believers in passive because beating the market is really, really hard. And we see this in data year after year after year. We quote the SPIVA studies almost every year. And the most recent one showed that over the past 10 years, about 90% of active U.S. equity managers did not beat the market. So that's one of the reasons we believe so much in passive. The other kind of core tenets that we believe in are diversification, low costs, and staying tax efficient. So our advice to investors, especially individual investors, now is kind of the same as it always is, which is kind of boring, sorry. But it's build yourself a portfolio of low-cost index tracking ETFs that's a good match for both your goals and the timeline of those goals, and your kind of psychological or subjective ability to take risks. We want you to have a portfolio that lets you sleep at night, because one of the ways that investors hurt themselves the most is by getting spooked when markets go down and selling low and then buying back high when the markets are on the rebound.
That's music to a lot of ears, I presume, right? What sectors outside of artificial intelligence are kind of coming up on your radar? Maybe we can let's start with Sam. Any alternative ideas? I mean, all of us are obviously big on AI, and the event kind of echoes that fact as well, but what else?
So there are other things besides AI out there, obviously. So a couple, on my hit list right now are, especially within the private markets, are defense technology. So, thinking about the defense systems of tomorrow and how do we fund them today. It could be something like a missile system. It could be something like a drone operator. It could be cyber tech. All of that is going to be super important. FinTech, obviously AI is revolutionizing that as well. But there's plenty to do within FinTech in terms of payments, in terms of modernization, stable coins. One of my favorite podcasts is the Money Stuff podcast. And I just love hearing about stable coins there. It's fantastic. And then I think the last part is one of the last sectors is really agriculture and ag tech. There's so much to be done in terms of the food that we eat, the way that we harvest food and grow food, and how that is transported around the world. That's a really ripe area for investment as well.
So thank you for bringing that up. By the way, for those of you who don't know, I actually cover fintech. That's my space. But we've also done a lot of work around stablecoins, and definitely a lot more interest around that now and this year. Scottie, any other themes that you'd flag?
Yeah, I think sports is another one. You're seeing now much more opening in terms of private markets and institutional firms being able to invest in the sports ecosystem. So you've seen, a number of firms, including ourselves, who have recently launched larger strategies to focus on that. So I think you'll continue to see, good kind of private partnerships in that area. And it's just a very durable area of investment that there just hasn't been as much access to historically in that regard. And I would say, otherwise, I think you touched on really a bunch of the major themes. The only thing, again, going back to is it AI or is it not AI? I think, especially for us as a firm, because we don't tend to focus on the stuff that's necessarily the earlier stage, actual, potentially like AI, LLM type businesses, but lots of other parts of the ecosystem, infrastructure plays, the power grid, all of the, parts of the system that are going to have to, be significantly invested in order to support that incremental demand that, data centers are going to create, I think is an interesting way to play it that's not as on the nose.
That's a very good one. So I wonder if this term has already been coined, but maybe we can call it the AI bleed. Like whatever AI goes, touches, changes, like that's the space that we can kind of start looking at.
Except it's scary for all of our individual power bills, but.
We'll definitely come back to that. But Alex, from your perspective, you also wear the hat of customer data analytics, right? So can you share any insights that you have learned by just seeing what people are doing on your platform?
Sure. So over the past few years, we've allowed more control and granularity in our clients' portfolios. In 2021, we started letting our clients build portfolios of ETFs, which we would then manage using the same technology that we use for our Wealthfront build portfolios. A couple of years ago, we also let clients start buying into individual stocks and ETFs, where they can build portfolios of individual stocks that they can just buy with a click. And a couple of interesting trends. So both of those things have been a good source of data for us. And one thing that we've seen is people want to take more risk pretty consistently, whether that means just deleting bonds from the portfolio or concentrating into U.S. assets. There's definitely a trend towards more risk.
Chasing returns, you mean?
Yeah. The U.S. centric portfolios have kind of that trend has kind of slowed down this year, and we saw a pretty sharp increase in allocations to pure Europe. So there's definitely some returns chasing going on. One interesting thing in the stock investment or individual ETF investment, we saw a lot of people just holding ETFs, VOO, QQQ. And that actually informed part of our strategy to invest more into our direct indexing offering. And then the last kind of interesting sort of idiosyncratic thing is a lot of people are interested in passive income. I think generally, but also in their investments.
And that's across generations?
Across generations, but surprisingly, it's actually the youngest generations that seem most interested in it, which is a little counterintuitive to me. They still want to invest for growth, but they want to set aside a bucket, I guess, that generates income and helps, give them some more spending money.
That's interesting. And I think that probably also kind of reflects on the interest rate environment. We've been in higher for longer kind of regime. So
past couple of years, you can do that. A couple of years before that wasn't much.
Yeah, exactly. Actually, I'd be remiss if we don't talk about risks in this environment, right? There are some common concerns around CapEx investments in AI and what happens if and when the market focus kind of shifts away from everything is so amazing and AI is going to change the way we live to hold on, what's the ROI on these investments, right? And that exacerbated by a slowing macroeconomic environment, sticky inflation, potentially weakening labor market. What does that mean, right? So, and then we have industrials and energy multiples have expanded, and people are wondering, is that also like a sneaky AI trade? Like correlations between tech and energy are so high now. So I think it's important to kind of think about what risks to kind of be mindful of, right? Samantha, what are some of the things that you are kind of watching very carefully going into 2026?
Too many to name. But on the private side and within hedge funds and alts as well, I think there's a lot of the dearth of distributions that have come from private fund managers is incredibly, incredibly challenging for limited partners right now. If I look back at a pacing model of what I thought the capital calls would have been for a fund that's about 5 years old, we're at about half the DPI that I would have expected just from natural, cash flows off of a fund. And you think about that across all the funds in your portfolio, that's incredibly detrimental for what you can make and pace into future investments within privates. So I think that's risk number one. The second risk is really just the IPO market. In order to have generational wealth transfer within the venture space, you need these generational returns that come, every 10 to 15 to 20 years within the venture market. And that has traditionally come from companies going public. And that has not happened yet.
Well, I'm not going to complain about that because we had quite a few companies, Klarna, Chime, Circle, at least in my space, Galaxy, Toro, we've seen some unlock, but do you think is the market really open?
It's not open. It's getting better, but it's not where, we had expected it to be at the beginning of this year. And obviously that is coming off of the dearth of distributions on the private side. This special problem within venture is the IPO market, which really has not opened yet.
Scottie, you work with a lot of companies pre-IPO. What type of solutions are you recommending for companies that are looking to go do an IPO?
Yeah, I think, it links very much both of the topics that Sam was talking about. So you see, a lot of private equity-backed businesses that we happen to work with, and, IPO, especially for a number of the larger portfolio companies, might be the only, option, but they don't know that they can necessarily go yet, or, they haven't quite grown into the valuation that they had a few years ago. I know we're going to get into that in a minute. But there can be sort of creative pre-IPO structures that can help them de-risk ahead of that. So a very common problem in a private equity company is they're going to be levered in a private context that's not going to work in a public context. Or they might want to pull forward some distribution ahead of it because maybe they're not going to sell as many of their own shares, but they want to get a distribution out to their LPs ahead of that IPO. So we can come in and give them basically what we refer to as hybrid capital that isn't debt. It typically converts automatically at the time of IPO, so it helps them clean up their cap structure, but it's not as dilutive as common, and it gives them the flexibility to bring on some capital again, whether it's to be a growth initiative, to give them some liquidity, or just to straight delever the balance sheet so that they're in a better position to go public, typically in the next 18 to 24 months when they take on a security like that.
So then that sounds more promising going into 2026, right? Hopefully we will have that windfall of IPOs after all, and especially with rates going down, right?
That's the hope.
Before we hop on to the whole IPO M&A space, I just wanted to come back. Alex, so much wealth creation has happened in the private space, so there's always this question of how do I get access to it, more from a personal investing as well, but What are your thoughts around that?
Well, what we tell our clients is don't. don't seek access.
Why?
I can explain why. Yes, sure. Going back to the four kind of core tenets that I mentioned, one of those is fees, right? And fees in private assets or alts in general tend to be really high. So there's a built-in hurdle that's pretty high to beat the returns of public markets. And continuing on theme, or the theme of price, access is great at the right price. What we see, or what I've seen in private markets is, there's the price per share, there's the NAV per share, and then there's what you can actually sell those assets for. And sometimes those three numbers can be pretty far apart, especially the price per share and what you can actually sell the assets for. So I'd be really concerned about liquidity. I've seen funds that are gating withdrawals or, talking about liquidity mismatches where people want to get some of their money back, but they just haven't been the exits or whatever, where the cash or the distributions haven't been coming.
But aren't they marketed like a good alternative?
I also very much dislike the way that they're marketed. I saw a pitch recently that said two or three things. It was low volatility, low correlation to public markets, and they hold up well in drawdowns, which, if I'm honest, I don't believe any of those things. I think they're basically levered small cap equities, with some management skill potentially on top of that. Hopefully on top of that. But I don't think you can tell me there's a person out there that really thinks that the value of those private assets isn't going down when the S&P 500 goes down or the Russell 2000 goes down.
Well, to that point, I don't know if you guys have followed, there is a new change being proposed that public companies don't need to report quarterly. I'm not complaining. I think I'll be very happy if I don't have to do quarterly results, but that also kind of moves in that direction of a little bit of more opacity, like in terms of information sharing and stuff. And companies are still staying more private for longer. And Samantha, we were talking about it, right? Like, we were fascinated by unicorns a decade ago, and then we had decacorns, and now we have like $500 billion companies, OpenAI, now Tether, that refuse to go public. Like, what's going on? How long can this continue?
I think it can continue until shareholders revolt or, limited partners revolt. Or there's some sort of regulatory change. Barring that, why would you change what you're already doing? You have no incentive to change. But the melding of the public and the private is really interesting because, as you said, having potentially a public company not have to report as often, private companies are able to raise larger and larger rounds, like very large scale growth rounds, and maybe they don't need to go public anymore. I think that it used to be every CEO wanted to go public, like that was what they wanted to do. And I think with the markets changing, that doesn't seem to be the end goal that people are really aiming towards anymore. And I think that has so many implications across markets, public and private, equities, bonds, infrastructure.
Yeah. Why go public when you can be a $500 billion company just being private, right? And why deal with analysts like me? M&A. With rates coming down, we were hoping there'll be a lot more activity. I have seen some in my space, like the FIS global deal was a big one, but a lot of eyes are still waiting for more, right? And this overlaps with the time when PEs are struggling to realize their investments. So valuation bid-ask spread still pretty high. How do you kind of bring those two things together, Scottie?
Yeah, it's a persistent problem, again, related to really all of the themes that, we've touched on so far. There was just speaking to the private equity disconnect in particular, there was some research out, I think, from Hamilton Lane a couple months ago, and it showed basically, the marks in private equity portfolio companies relative to the market clearing price. And it's like a number of the sectors were, a gap of like 25+%. So it's, no mystery as to why it's really hard to get, transactions done at this point. I think that's why, at least in a private markets context, you're seeing a lot more interest in structured capital, as there's just a recognition that you can't get a plain vanilla, LBO done in the same way. And maybe in some certain circumstances, you're going to have an excellent strategic outcome, but especially if it's like a PE to PE trade, that's really challenging to do right now. But if you use sort of structured capital, you can use various bells and whistles so that maybe you don't have to set a valuation, maybe that valuation moves, maybe you can give a certain headline valuation, but in the background there's some minimum MOIC and other types of protections for the investor, so that they're de-risked to the extent that valuation doesn't materialize. So I think it's driven a lot of interest in the structured capital alternative to create some kind of liquidity mechanism or help facilitate M&A so that they can, grow into their valuation, which is always a fun phrase.
I thought you really need to wash off all your 2021 sins before you can actually see some unlocking happening.
It's just going to take more time.
Yeah, no, but I think that's a good out. Like structured capital looks like a good out. So looking forward to seeing a bit more of that.
We think so.
I cannot get out of this room before addressing the elephant in the room, AI, of course, right? So we discussed about the risks around AI capex and especially with the weakening environment. And now NVIDIA investing in OpenAI, that's kind of a whole different conversation about circular investing, right? And it kind of gave me the vibe of a little bit of the whole global financial crisis, where we completely ignored the risks of interlinkages between these companies. I'm just curious, how real is this concern around overinvesting in AI? And maybe let me start with Sam. Do you think we are in an AI bubble already?
Maybe. I mean, if you've read the press in the last 3 days, it's like the word AI and bubble have come up more times than I care to read. But, that being said, the amount of money that is going into AI across different projects and asset classes, the way that it's transforming business life and personal life, I'm probably not the, first person that people think of when they think, are you using AI? It turns out I am. That's shocking to me. I think that, my kid would use it or, the younger generation would use it. But I'm using it every day. And so, when you have that level of integration, I think, even if we are in an AI bubble, it can go on for a very long period of time.
That is the key question, right? So usage is one thing, but how do you make money off it? So let's poll the audience, guys. You've had enough sitting down. Let's hear some thoughts from you. How many people here think we are in an AI bubble already? Raise your hands, please. Very few. That's amazing. How many of you worry about being overexposed to AI right now? How many of you wonder if we are not enough exposed to AI or have missed the last cycle? Now I'll see a bigger raise of hands, I guess. Okay, so coming for you, Alex. Mag 7 clearly weighed, you saw them grow grow their proportion within the S&P 500. The last leg was obviously a lot of AI rally. How does Wealthfront recommend positioning on the whole AI trend?
I guess there are two sides to that. One for the people who think they're not exposed enough and have FOMO, and for the others for the people who worry they're too exposed. For the FOMO folks, you're invested in AI. If you're invested in the stock market, you're invested in AI, whether it's companies that are making chips or data centers or models or energy. There are AI exposures all over the place in the stock market. And for the folks who are concerned that they may be overexposed, we just, again, stress diversification. The top 10 stocks, which are very, very techy, a lot of AI investment going on there, about 38% of the S&P 500, about 32% of the total market, and about 20% of the global market. So you can diversify away quite a bit of that exposure.